Welcome to Introduction to Securities Process video. In this video, we will cover why securities actually came into existence or why there was a need of securities or different type of security instruments and the segregation of securities process depending on different functions the department do. Why did securities or different security instruments came into existence? To start with, whenever an organization or a business or a corporation wants to raise some capital, the traditional way of raising capital was to getting loan from banks or from any government institutions. However, those always came with some foundations or some limits for which corporations had to oblige with or be restricted with. So to raise capital where corporations can approach the public at large, where they can directly approach the public, for that purpose securities actually came into existence. Now capital raising by way of securities actually provides corporations and even governments with the ability to choose between a mixture of security instruments. To go by the basics, if an organization or a corporation issues shares to raise capital, they are not obliged to pay back the shareholder anything, not even the dividend. However, if same organization wants to raise capital through debentures or bonds, then they are liable to pay whatever is the agreed amount at that frequency. So, if an organization is of a view that they don't want to be obliged all the time to pay, they will try to raise capital by shares rather than fixed income or debentures. But now if a company issues shares, it is not liable to pay anything, but the shareholders or the buyers of the shares become the owner of the organization, and they can actually impact the decision making of the company. So if a company wants to make or work with independent decision making ability, they will opt for fixed income or debenture type of capital funds rather than issuing shares. So here we can see that in different type of mixture of securities, a company can flexibly raise funds from public at large. In secondary markets, whenever there is a trading between a seller and a buyer, the securities also needs to change hand in the real world. It can be cash, it can be equities, it can be fixed income. So here we have functionally segregated that securities process into three departments, which are front office, middle office, and back office. Front office deals with investment decisions and trading activity. Investment decisions like from here where to buy, from whom to buy, and at what price. Once front office finds opposite party, for example a seller finds a buyer, then a trade is set to be executed. At that moment, that information flows into middle office, whose responsibility is to complete the booking, send a confirmation, and check into the accounting of that trade. Middle office also looks into the legal obligations of that trade, if that trade is valid as per the exchange requirements, as per the legal bindings of that particular security or that particular country. Post booking in middle office, the trade has to flow into back office, which deals with actual movement of shares from the seller's account to the buyer's account. Back office deals with the local custodian, the depository, and has to take care of both the cash and stock. Even after settlement, back office may need to do some reconciliation activity to understand if the settlements or the shares and cash transfer has been as per the agreed trade details.